You drop $1 billion on a restructuring plan, explicitly tell Wall Street it is not a cost-saving measure, and your stock immediately spikes 22%? That's the kind of paradox we are unpacking today on Earnings Unscripted. It's May 13th, 2026, and we are looking at Cisco's Q3 2026 print, ticker CSCO, and the tape after hours was just wild, touching $122 a share. Miro, did they just invent free money?
No, but they figured out how to forcefully price the money they are making. Look, the baseline math is solid here. Top-line revenue came in at $15.84 billion. That's up about 3% sequentially. Earnings hit 85 cents a share, up from 80. But what the market is aggressively rewarding is the velocity. The hyperscaler order book basically tripled year over year.
Right, because last quarter we were talking about them plumbing the AI factories, but now they're taking their full-year AI target from $5 billion to, wait, it was $9 billion, right? That is just a massive leap.
Yeah, $9 billion. And the core networking segment is fueling it. That jumped to $8.82 billion for the quarter. But the really fascinating part, the tell on their actual market power, is that they engineered a good chunk of that order growth simply by squeezing their buyers.
Wait, squeezing them how? Also, quick obligatory legal note before we claim a tech giant is extorting people. This is just a podcast, not financial advice, purely our personal opinions. But seriously, what do you mean they squeezed them?
Well, inflation on global memory components is pretty brutal right now. So management basically changed the rules of engagement. They went to customers and cut the time their pricing quotes are valid in half. They gave them a 15-day window. It's essentially lock this order right now or the price goes up next week. That artificial urgency actually generated roughly 4 to 5 percentage points of networking order growth.
Like literally a used car lot tactic. Like, the manager leaves at 5. This price is only good until then.
Exactly. But, done at scale with hyperscalers. And it works. It completely insulated them from the inflation hit. It's why their operating income expanded to $3.96 billion despite all those supply chain costs. They just brute forced the margin protection.
Fair enough. Although, they are still taking a hit on the software side, right? Like, security revenue actually ticked down 0.5%, which feels weird next to all this AI growth.
It does, but that's mostly an optical illusion from Splunk. They're ripping the Band-Aid off legacy licensing and pushing everyone to cloud subscriptions. It hurts short-term GAAP revenue, but it builds out the recurring base.
Okay, so the core business is absolutely firing, but then you still have this one massive weird puzzle piece, the $1 billion restructuring charge. Because normally when a company drops $1 billion on headcount changes, it means panic. All right, let's get into the details on what is really happening there.
Yeah, because if you actually read the transcript, it is almost an anti-restructuring. Usually a company takes a hit like that to appease activist investors, to cut the fat. But Mark Patterson, their CFO, explicitly framed it differently. He said, and this is an exact quote, "This was really not a savings-driven restructure. It's really things are moving incredibly fast right now. Being able to move fast, we don't always have the exact resources that we need going forward in the right places."
Okay, so they're basically orchestrating an internal coup.
Exactly. It is ruthless capital allocation. They are forcibly stripping budget from legacy projects and pouring it directly into silicon, optics, and AI. They want to be the underlying physical layer for these massive hyperscale data centers. It's the Appleification of Cisco.
Wait, Appleification? You mean vertical integration?
Right. They historically relied on merchant silicon, just standard off-the-shelf chips from other vendors. But now they are replacing competitors inside Tier 1 hyperscale clients with their own proprietary chip, the Silicon One P200. Chuck Robbins even pointed this out. He essentially said, if you don't have your own silicon, you're going to struggle to stay relevant with the hyperscalers. So, you build it yourself. And to do that, you need different talent. You let go of legacy hardware managers and hire chip architects.
It's fascinating because they aren't just swapping out people to deal with this market. They're literally mechanically changing the actual products. Because we talked about them squeezing buyers on pricing a minute ago, but there's a whole second half to that supply chain story, right?
Yeah, and this is probably my favorite detail from the entire print.
The memory engineering thing.
Yes. Look, Most hardware giants, when global memory components skyrocket in price, they just take the margin hit. They go on their earnings call and complain about macro headwinds. Cisco engineers just redesigned the physical box.
Sort of a math is cheaper than memory approach?
Literally. Patterson noted they put 20-plus internal programs in place to reduce memory utilization natively. So by Q4, they are rolling out completely new hardware SKUs that actually require 50% less physical memory to operate.
Honestly, that is kind of brilliant. You sidestep the inflation simply by designing the dependency right out of the blueprint. But hold on. If they don't convince clients to migrate to the new low memory configurations fast enough, wouldn't the traditional gear just crater their margins? Because non-GAAP gross margins are already down, 260 basis points year over year?
Roughly, yeah. And that is the real operational risk here. The Q4 transition has to be flawless. They did strike a 3-year strategic supply agreement directly with Nanya to try and hedge those memory costs. But if customers balk at the new architecture, or there is a hiccup rolling it out, that 64.3% product margin gets ugly very fast.
So it really is all about velocity for them right now, moving the people, altering the product design, all just to catch this hyperscaler wave before it crests. So where does that put their actual trajectory going into the rest of the year? Because $1 billion in reshuffling has to leave some bruises, doesn't it?
It leaves a bruise, sure, but honestly, management is acting like they don't even feel it. If you look at the guidance, they are leaning all the way in. Patterson is guiding Q4 revenue up to a range of $16.7 to $16.9 billion. That is a steep sequential acceleration.
Wow. Okay, so they really are not slowing down at all.
No, not even slightly. Patterson actually called fiscal 26 their, quote, strongest year ever. And the conviction is purely coming from the hyperscalers. Robbins flat out said on the call that they expect to take about $9 billion in AI infrastructure orders this year. That is 4.5 times their entire total from last year.
4.5 times. That is, that is not a pivot anymore. That is just an entirely different company. It feels like they are sprinting right now. But, sprinting always carries a tripping risk.
It does. The execution window is incredibly tight. They are ripping up the floorboards while the house is full. If that new low memory hardware they're pushing for Q4 hits an engineering snag, or if these cloud giants just suddenly decide they overbought and tap the brakes.
Right. The music stops.
Exactly. The music stops. But for now, they are playing aggressively. I think they finally realize that hardware is being forced to move at the speed of software. You either rewire the whole company to match that pace, or you just slowly fade into a legacy case study.
A legacy case study. Brutal. But honestly, completely fair. It really does look like they are actively dodging that fate, at least for this quarter. All right, I think that is a perfectly realistic place to park this one.
Works for me.
Awesome. Thanks for hanging out and unpacking the numbers with us, everyone.
Catch you next time.
If you want these earnings drops to just naturally show up in your feed, go ahead and hit follow. And just as a quick aside, we actually use AI tools to generate this entire podcast to test how realistically synthetic voices can banter about complex financial filings. So if you have any feedback or a specific ticker you want us to pull apart next, just shoot an email over to earningsunscripted@datamadness.ca or find the X link right in our show notes. Have a great week.
See you out there.